you study that unit in the partner university. Those units can be coded against a general elective unit or a core unit. So these are contact details there. So if you're interested in attending one of those programs, you can contact us. We are located in Building LB, which you can come and see me if you'd like. Just one thing I'd like to mention is the cost. The faculty tries to subsidize the cost as much as we can. For example, the WHEEL program that we have to Vietnam, the program cost is $2,000, but we will give you $2,000. You just need to pay for your flight. So you can get flights to Vietnam for about $500, $600. So essentially the program is free. You just have to pay for your flight. So, and for the marketing program as well, we give you a $2,000 grant as well. So we try to make it affordable for your students to go. So I'd highly encourage you to take part of them. Thank you. Thank you very much. Yeah, so good.
Okay, so getting back to the lecture, and like I said, today we start topic 2, and it is the most important topic. We will spend a minimum of 3.5 weeks on topic 2, okay? And eventually we'll see in the final exam, some version of topic 2 will go to the exam as well, all right? It is all about the fundamentals. So please make sure that you're comfortable with our discussion so that the rest of the trimester will be straightforward for everybody. And so, by the way, I just want to bring you back to the website for the unit. So everything, all the resources that I mentioned last time can be found in this area, right? It is where you should go. You should check on a regular basis. Within the resources space, you can find all the relevant information, in particular the lecture slides, and from time to time, online reading materials. So please make sure that you are comfortable with the structure of the website for the unit, which is similar to other units, okay? If you have any questions, how to play with the website, let me know. Otherwise, I assume that it is straightforward, right? Just a few areas for you to go in order to obtain the information. And in this area, in the news section, from time to time, we will upload important announcements, right? For example, how to submit the assignment, and right? What are the steps you need to follow? When the due date, whatever. So we'll keep you active throughout the term with, regular updates on the development of the unit. So make sure that you check the website on a regular basis, not necessarily every day, but a few times a week, all right? In case you find something relevant for you. Any questions before we move on? The assignment, like I said, I get back to that next week, okay? And you don't have to do anything between now and end of this month. Nothing to do. Of course, if you want, you can just give it a go, right? Take a look at the financial markets, gather information, build up the hobbies on some particular currencies between now and then. But the plan is that before end of March, we will provide you with the login details so that you can trade currencies and start writing the report. Between now and end of March, you don't have to do anything, right? But next week, the week before we provide the accounts, I get back to the assignment document. I will go through some important points again, okay, a little bit more detail than last time. And in week 4, of course, it is the time when we very much start with the assignment. I will go through the marking criteria, right, and explain how to trade currencies so that everything will be transparent. Okay, so topic 2. So today we do part 1 of topic 2. Topic 2 has 3 parts, right, for the information. Part 1 today we will talk about the foreign exchange market, the exchange rates, basically the fundamental stuff. Next time we will move on to the balance of payments accounts. Okay, so it is similar to the accounting report for a business firm, but now we're talking about the report for a country as a whole, right? So that has things to do with international standards. So we'll go through the IMF definition of the elements within the balance of payments for a country. Am I? Export, import, whatever. And part 3 will be mainly about the analysis into the market, into the forex market. Okay. Part 3 will be useful for the assignment as well as the final exam. All right. So we'll look at the fundamentals behind the market. We will talk about the demand side of the market, the supply side of the market, am I right? And the equilibrium. What would happen, for instance, if the Reserve Bank of Australia decided to lower the cash rate? Right? As you know, it has been 1.5% for a little while, more than a little while, has been there since at least late 2016. Am I right? It has been a record in terms of the history of Australia that the rate is kept on hold. Okay, no change, 1.5%. And many people are thinking about a potential change at the moment. Am I right? But we follow the headlines, still not yet clear. Am I right? The views from RBI is quite different from the market analysts as well as economists, correct? In some sense, RBI is more concerned with the big picture, am I right? The performance of the economy as a whole. Market analysts, economists, they are more concerned with, of course they are also concerned with the big picture, but they look a little bit deeper in details in some areas in the economy, right? For example, the housing market, they are now talking a lot about the housing market. Does it have something to do with RBI? And the RBI boss has made it very clear in the last few days that we are more concerned with the big picture, things like unemployment, economic growth, am I right? Housing market, of course, is important. As long as it doesn't have anything to do with unemployment, it's not a concern. Okay, something like that. So we'll go through the details in topic 2, part 3. Okay, so today our discussion will be based mainly on the text, right? The text, chapter 5, and you might want to take a look at the chapter to see more details. But basically, this is the plan. We go through the foreign exchange market, where we define the market, we look at the elements of the market, who participate in the market, and so on. And then we take a close look at the spot exchange rate, as well as the forward exchange rate. Right? So these 2 exchange rates, they are basically the most important ones. Right? We see in every market. Right? The rates are available, and eventually, when you do the assignment, you will need to trade these instruments. Right? So it's a good idea to be fully fledged about the concepts, and you can be on top of the learning curve. Some motivations. In 2002, so this is coming out not from the text, but from a different textbook, right? Which we used to use as the main text for the unit. So according to that alternative text, right? In 2002, so one of the senior member in the management board of the National Australian Bank, NAB, right? One of the big 4, as you know, indicated that the bank's profit would drop by 20 million Australian dollars for any penny that the Australian dollar appreciated against the pound, the British pound. Okay? Just 1 penny change in the value, that will change the bank's profit by a significant amount. And the question is why? Why does it happen? What does the pound have to do with the performance of NAB? Obviously, say again? Investment, in particular investment by NAB in the UK. Okay. Yeah, so NAB, not anymore, but it used to have a significant business in the UK. Okay. So the Clydesdale business is now on the market, right? NAB has already put up the exit plan, and it put the business on the market. Not anymore, but it used to be the case that the business in the UK generated a significant amount of profit for NAB, am I right? And the problem is NAB is located in Australia, am I right? And the business is in the UK. Right? One of the branches is in the UK. So clearly, at the end of the day, am I right? Somebody has to do the conversion, correct? Because whatever business you do in the UK, you might earn some income denominated in the pound, not Australian dollar, am I right? In the pound. So somebody has to convert that amount into Australian dollar, because at the end of the day, right, you cannot report to your shareholders that you are making 3 billion Australian dollars and 1 billion pounds. What does that mean? Am I right? People would get confused. Can you just give us one number? Am I right? And the same thing, the tax authority might come back to the bank. What do you mean by 3 plus 1? Okay? Can you just tell us your income in Australian dollar? You have to do it because that is a tax rule. So clearly, the change in the exchange rate becomes very, very important, right? If you have something, if you have an exposure in a foreign market, you have to convert the amount across the currencies. And in this particular case, right, if you look at the statement closely, it is quite obvious that NAB was in a position very much to buy Australian dollars, correct? To convert means to buy, right? NAB. So, well, of course, the transaction might not occur, but technically, right, when you convert a certain amount of assets denominated in the pound into Australian dollars, right, you are buying Australian dollars, very much the same thing. So here, if the Aussie dollar goes up, the price of the Australian dollar goes up, clearly it costs more money to buy the Australian dollar, and that is going to be relevant in this case, right? So, as long as the Aussie dollar appreciates, NAB is not in a good position, right? But of course, like I said, it's not the case anymore because nowadays NAB is focusing on the Aussie market only. Now, another good example is on the 8th of October 2008, there was a lot of chaotic events during this period, if you follow the headlines, right? Starting with the collapse of Lehman Brothers, am I right? So they led to a lot of chaotic events in the global financial market. And on this single day, the Aussie dollar depreciated significantly against other strong currencies, right? 9% against the greenback, 11% against the Japanese yen within a few hours. Okay, within a few hours. Of course, we need to know why. So Lehman Brothers applied for bankruptcy, filed bankruptcy in September, not October, am I right? But it was, I think, from my understanding, was a lot of risk in the market during this period that governments, not just traders, investors, but also governments around the world, they were so much worried about the assets they were holding at the time, am I right? And many countries decided to cut the interest rates domestically, am I right? Australia, the day before this one, Australia lowered the cash rate by 100 basis points. Okay, it was already a massive cut, but the market was thinking that it's not enough. Okay, so that was the way, and people expect a lot more significant cuts. So this is unusual. Okay, this is very, very unusual. Eventually, when you trade currencies in our platform, you will see that in one day you might see about 1% change, right, up or down, or maybe 0.5%. It's not like this. So this is very rare. You may not see that again in the short term, but just keep in mind that it can happen. Okay? Risk is there. It can happen. And the reason is quite obvious here, because the Australian dollar is linked to the world economy in a very strong way. Am I? Because we have a very good mining sector that is linked to the performance of the global production. Am I right? As long as the world economy is performing, our economy should be performing as well. Okay? Because they are linked. We export mining products to the world. So if the world is doing well, we should be doing well. Am I right? And if the world suffers, we will suffer a lot more, because people will change their behavior, right? Not just the performance is not improving, it is also the confidence. Investors, they will lose the confidence in the Aussie dollar, okay? When the risk is too high. All right. And in an interview on television, Australian television, conducted in Jan 2011, at the time when the rate was 0.95, one Australian dollar was equivalent to 95 US cents. All right, so we get back to the concept in a minute. So almost no one, no economist, no expert predicted that the Aussie dollar would go up to parity against the greenback. Okay, so 0.95 is already too high. Okay, because like I said, the normal views is that the long run equilibrium is 0.8. Okay, many people think it should be the case. It doesn't have to be 0.8, but it is the belief by many economists. So 0.95 is too high. So no one would believe that the Aussie dollar would go up to parity, 1-on-1 against the US dollar. But it did happen, right? It did happen. It did happen. And if you check the history, if you go back to the chart, one way is to check the RBI's website. You will see that in 2011, the Aussie dollar was reaching about 1.1 US dollars. Okay, too strong, right? Too strong. Of course, it has since dropped, and at the moment it's sitting around 0.7. Am I? 0.7, 0.71. It has touched 0.7 a few times in the last few months, and there's a good chance it will hit that level again. Okay, so this further information. So predictions by economists, you should listen to them, but put them in context. Okay, don't think that, don't think that when you see someone saying the rate should be 0.8, it will be 0.8 in a few days. Okay, it might happen in a few years, not within a few days. Right? So the prediction by experts, they are useful, but very much you have to put them in the context. Okay, so this is the Aussie dollar. Again, if you take a look at this chart, you're going to see that the Aussie dollar has been down and up and down and up and so on. Am I right? Just for the information, right? So the record low for the value of the Aussie dollar was established in 2002 at the beginning of the mining boom period. Okay, 2002. At that time, the Aussie dollar was around 0.47. Okay, 0.47 in 2002, the record low, and because of the mining boom, it went up it went up. So by the way, the line is showing the strength or the value of the Aussie dollar, am I right? So forget about this expression for now. I will get back to the concept in a minute. But this is all about the value of the Aussie dollar, okay? When the line is going down, it means the value is going down. When the line is going up, the value is going up, okay? So during the mining boom period, from 2001 to 2008, right, the Aussie dollar was going up and then suddenly down due to the global financial crisis, okay, 2007, 2008. And in topic 7, we talk about that particular crisis in details, right? Why it happened and what were the policy responses. And then after that, the currency quickly recovered, going up to 1.1, as we just discussed, and back down again at the moment around 0.7. Okay, so always changing. And in topic 2, part 3, when I will get back to this historical trend, when I mentioned the RBA's cash rate policy, right? So it is linked very closely with the RBA's cash rate decisions. All right, so we are ready to define the markets. So the foreign exchange market is defined this way. Sorry if it's too long, but that is a very good definition, right? It is coming out of the text. It is a market which encompasses the conversion of purchasing power from one currency into another, bank deposits of foreign currencies, the extension of credit denominated in a foreign currency, foreign trade financing, trading in foreign currency options and futures contracts, and currency swaps. Okay, and within this unit, when we talk about FX market, we imply the foreign exchange market, or in short, the forex market. Okay, so it doesn't matter which one. In particular, in the assignment, you can use any of these terms. Okay, so a lot of elements of the market, am I right? So, but basically, mainly, we are talking about foreign currencies. Am I right? If we don't have foreign currencies, there's no need to study this unit. Am I right? No foreign exchange market, everything becomes so easy. Am I right? But because of foreign currency, we need this definition. We need to understand how the forex market works. So, looking at this concept, right, we have a few things, right? Currencies for sure. It is the main instrument in this market. On top of that, we have other important assets that should be mentioned. In particular, currency options and futures contracts. So in topic 5, we will have a discussion on those currency derivatives, right? And we look at their functions in this market. Currency swaps, where we don't have the time, so you don't need to read about currency swaps within this unit. Okay, so currency swaps so the idea is simple, right? So suppose I need some Japanese yens, correct? I have a business in Japan, for instance. I need to raise some Japanese funds so that I can run my business in Japan. And some Japanese guy is having a business here in Australia. He needs to raise some funds in Australian dollar. Okay. Now the problem you can see obvious, right? For me to raise funds in Japanese yens, it would be very difficult because I'm not in Japan, right? I have no idea how the market works out there. But my friend, okay, he's in Japan. He can do that thing for me very easily, am I? And of course, for me, I can do the same thing he wants in Australia for him fairly easily because I know how the market works here, am I? So currency swaps will be useful because we can sort of like help each other, okay? I do everything for my friend on his behalf and he's going to do everything for me on my behalf in the fundraising activities, okay? So, and then at the end of the day, we just exchange the amount, okay? So it is a win-win position for me and my friend. But you don't need that in this unit, right? Okay, so I guess most of the terms in the concept are clear, but do let me know if you want me to explain anything. We're not a fan of these things, right? So we're not just serious about the wording of definitions, concepts, for example, right? In the exam, if you're asked to define something, just put up a definition by yourself, right? The way you understand what it means. You don't have to memorize these things, right? There's too many things. But just keep in mind those instruments, right? Those elements within the definition, right? We have currency, bank deposits, credits, trade financing, and some derivative products. Okay? So they are the instruments of the market. So some important features of the market, the commodities in the market. Obviously we have currencies, all right? Currencies, but they are not everything. We also have bank deposits in various different currencies. And if you go to the report by BIS, which I will show you in a second, bank deposits, they are more important. Okay, bank deposits, they are more important. So currencies, they form a small part of the market, of the entire market. But bank deposits, in particular, the international banking, so the euro currency markets. Okay, so transactions in the euro currency markets, they form part of this market, correct? Because they are owned about foreign currencies, right? We briefly mentioned about that market last time. But basically, the London market where LIBOR rates are set, right? We have 35 LIBOR rates, and all of those transactions, they are part of this market, right? And those transactions are huge. Okay, you can see the sums of millions or $billion. So the market is the most perfect of all markets. So this is probably the most important one. Right? So if there's no comparable markets to this one. It is the most perfect one in the world in the sense that it is unique, right? And it is so famous, right? So what else do we have? What is the concept of perfect competition? So anyone remember from economics? What do we need for a market to be perfectly competitive? Many buyers and many sellers. Yes, good. That is obvious, right? First requirement, many buyers and many sellers. For sure, we have that here, right? We have millions of buyers and millions of sellers in this market every single point in time. What else? This one, exactly, homogeneous product, okay, identical commodity. The Aussie dollar that I have contains or carries the same value as the Aussie dollar that somebody in London is having, correct? They make no difference. They are Australian dollar, okay? So the value is the same everywhere, and they look exactly the same everywhere. So it is a perfect example for homogeneous product, right? Exactly the same product everywhere in the market. What else? Free entry and exit, right? If you don't like the market, you don't have to step in. No one can ask you to buy and sell anything in this market if you don't like it, correct? But if you like it, no one can stop you from buying or selling, right? So it is a free market. If I can do something here, you can do the exact thing. Alright? So we call that condition free entry and free exit in the market. No market maker, well, it's a little bit vague here because eventually, even since there are some important players, they can make the market to certain degrees. Alright? But technically, information is perfect here. Okay? Information is perfect. Look at the RBA's cash rate decision again, for instance. It is at 2:30 p.m. on the first Tuesday of every single month except for January. You see that when RBA announces the new cash rate to the market, everyone knows, okay? There's no way for you to know about that information before me. Okay? The information is freely available on the internet, on RBA's website, on television, on the news portal. Correct? And it is transparent. Right? So no one will have access to that information before the market. Okay? So that is strictly confidential. And RBA must announce that number at the same time on all news portals. Okay, that is the regulation. So clearly free information. As long as you know something about the market, I will know the same thing. So I don't have any advantage against you. Of course, if I work harder, right, I do more research, I might know more because you're lazy, that's all. Right? So the idea here is that if I have access to something, right, then technically you should be able to have access to the same thing. So in this market. So that is the most perfect of all markets. And not to say that the size is also significant, right? The size is huge. You don't have a comparable size. If you look at other markets, for example, the stock market, even the US stock market is not that big, okay? Australian stock market, tiny comparing to this market. Even Australian GDP, right? It is an over-the-counter market, OTC based. So the idea is simple, right? Commodity, currencies and bank deposits in the market must be in the hand of somebody. Okay, when we trade or when we transact, we change hands, those things, correct? So currencies cannot be nowhere. It has to be in the ownership of somebody, am I right? So that is the nature of this market. Currencies cannot be nowhere, okay? It has to be in the hand of somebody, you or me or someone else. That is the idea. So when we have transactions in this market, so basically currencies will change hands from one person to another. That's all. Okay? It has to be somewhere, owned by someone. And the daily transaction volume is huge. Am I right? So this is from 2013, and based on the BIS China surveys. So the Bank for International Settlements I mentioned last time, they conduct this kind of surveys every 3 years. At the moment they have the 19th version, so they are still in the surveying period. They will complete that in April. Sorry, the due date is April for the financial institutions to put in the contributions. Am I right? April, and then I think around September, October, they will announce to the market what they find. Okay, every 3 years. This is 2013 and 2016. Sorry, I don't have the time to put up the new numbers, but they were a little bit higher. So 2016, more than $5 trillion. Okay, $5.3 trillion. That is the daily transaction volume. Okay, transaction on one business day. It's not for the entire year, right? So you see that the size is huge. What is the size of the Australian GDP at the moment? It's about less than 2, right? Less than $2 trillion. Correct? Sorry. So this is for US dollars. So less than 1.5 trillion US dollars. Okay? Less than 1.5. And this one day, at the moment, 5.3. So you see that the size is huge. No one can control this market. No one can control it. So some stylized facts, if you look at this these figures, you will find some interesting information, okay? And it might be useful for the trading game because eventually you will need to choose some particular currencies or currency pairs in order to transact, to make money. And this figure is helpful because it is telling us what are the most frequently traded currencies in the world. So the US dollar, number one currency, right? Quite obviously. If you look at the the left-hand side chart, you see that the US dollar is the most important currency, right? And then it is followed by the euro, the Japanese yen, the pound, and we also have the Aussie dollar up there as well. Okay, so Aussie dollar is quite is a very active currency in this market. And it is, so the fluctuation of the Aussie dollar is quite strong, I believe, right? Because nevertheless, people still think that it is a risky asset, right? Everything denominated in Australian dollar is risky in the sense that we are connected to the world economy in a very, very strong way, okay? So as long as some risk is out there in the world, people will link it to the Aussie dollar, okay? So if the risk is low, then the Aussie dollar becomes safe, okay? If the risk is high, the Aussie dollar becomes a risky thing to do, okay? To invest, okay? So still that is a belief among many investors. All right, so don't worry about the numbers here. For example, 87% for the US dollar is, so the percentage for the US dollar is 87% among all transactions. Okay, what does that mean? It means out of all transactions in the forex market, you see 87% of those that involve the US dollar, okay? But if you look down, the second important currency, euro, you have another 30-something%, right? If you add them up, already more than 100%, okay? More than 100%. And if you go further down, you add them all up, you will see that, well, it's better if you go to the report, the original report, the sum of those percentages is 200%, okay? 200%, it's not 100%. What does that mean? This is the forex market, am I right? So one exchange rate pair has got two currencies in it, am I right? So if you transact, for example, US dollar against or versus Aussie dollar, both currencies will count, okay? They both have a position, correct? Because the transaction involves the US dollar as well as the Australian dollar, am I? You have to count them both. So in that way, if you add up all the percentages, it will have 200%, am I? 200%, because you count technically everything twice, okay, if you want. All right, but anyway, so I guess the more important thing is that the relative positions of these currencies, am I right? US dollar is number one, followed by the euro and Japanese yen. And then the pound, don't worry about big jump here, because from here down there, we have a different scale, okay? That is just for convenience, right? People try to fit everything in one chart, but it doesn't mean that the pound is more important than the Japanese yen, okay? It is way less. Okay, right hand side, if you are more curious about specific currency pairs, then you will see that this pair, US dollar / euro, it is the most important pair, am I right? Which is quite obvious because on the left hand side of that expression, we have the US dollar, and the right hand side of the expression, we have the euro. And they are number one and number two currencies, am I right? So that exchange rate pair is obviously the most important exchange rate pair. It doesn't mean that you have to trade that exchange rate pair in your assignment, you know, it's up to you. You can choose any currencies that you like. You can trade any currency pairs you like, okay? You don't have to stick to this table, but they might give you some ideas, right? Which one to choose, correct? Because it's quite obvious that given the US dollar / euro being the most important exchange rate pair, the fluctuations will be less in magnitude comparing to other pairs, correct? It is the benchmark in the world, right? So it shouldn't go up and down, you know, every second by 3%. It's not going to happen, correct? It's quite stable. And it's safer for you. It's safer. You can protect the investment position, right? If you trade, for example, Singapore dollar, right? It is a small, sorry, not, it is a, it's not, it is not a very popular currency in this market, right? Comparing to the top 5, correct? So you should expect a lot of fluctuations, right? As long as the position has a Singapore dollar in it, for instance. Right? I'm not saying that is always the case, right? It might be stable because it is linked to the US dollar, for instance. But these two figures, they provide some background information at the very least. Okay, this is about the positions of countries in the market, right? We see that the United Kingdom is number 1 player in this market, right? It doesn't mean that the pound is the most important currency, right? It has got historical reasons, the location reasons, the time zone reasons in it, am I right? So London is very convenient, right? Because if you think about, if you look at, for example, television shows on the first day of the year, right? They always start with the Australian firework. Why? Because we have morning before other countries. That kind of idea, am I right? So if you trade in this market, you will see that Australian market, the New Zealand market, of course, am I right? They are among the first to open in the business day, correct? So we open before even Tokyo, before Singapore, before London for sure, right? So after the Asian market, right? So after Australia, New Zealand, we have Tokyo, Singapore, right? And of course Chinese market. In the afternoon, when we are about to close our market, we have the European market to open, right? Given the time zone. And late in the night, we have the US market, right? So clearly, the European market is important because it's connecting the Asian market and the US market, right? It is standing in between, right? So if you are a big financial company, right? If you ignore the European market, it's not a good thing to do in the sense that you might miss out a lot of opportunities, right, during the day. You might profit from the Asian market and wait for the next day, or you might want to continue, right, to maximize a profit later in the day with the European market and then the US market, right? So European market has got a good time zone position. London, like I said last time, right, it has got a good history in global finance, right? It used to be number 1 world center for international finance, right? So clearly it has remained so. And also we have, I think the most important one is the euro currency market, right? Is the euro currency market. It is where the LIBOR rates are set on a daily basis. Most international banks, they must be there in order to participate in the market. And clearly London is very, very important. Okay, it has got a very, very important position in this market. So the size of the euro currency market is very, very significant, right? Because we have big players. They don't take transactions by small traders, right? By individuals. They are where the game is being played among the market leaders, right? The most important banks, they are there. So that's why they make the market from London, if you want. Okay. In topic 7, don't worry, it's a little bit too much for now. But in topic 7, I get back to the LIBOR rates settlement process, and we will understand more. Okay, good. And also, if you just a side note, if you look at the mining sector in Australia, am I right? So many mining projects, they need to go to London to talk to investors in London, because it's where we have the euro currency market that operates in large sums. Okay, so it is where you can get a lot of money. Okay, you can obtain a lot of funds. You can raise a lot of funds. Not here in Australia, very difficult. Am I right? Within this environment, very difficult to raise funds. All right. Other markets, United States for sure, it is important. Singapore, right? Japan, Hong Kong, and so on. Okay. Market participants. Let's take a look at the participant in the market. One way is to look at the participants based on the categories where we have these players: international banks, non-bank dealers, customers, brokers, and central banks. Okay, so they are there, and they play different roles in the market. Another way to classify the market is the objectives, if you want. Okay, later on I will show you another way, which is to look at the nature of the transactions of the participation. Am I? Why are you there? Okay, I'm there in order to hedge my position, for example, right? Then in saying that I am a hedger in the market, okay? I'm a hedger. I participate in the market to hedge some positions that I need to, okay? Or I'm there in order to make money, okay? Why are you there? Well, I'm there to speculate, am I? Buy and sell currencies in order to make money, am I? Okay, so let's take a close look at these participants. International banks. International banks. They are obviously most important players, right? Because they make the market. They make the market. So exchange rates that we see on the trading platforms, on the news portals, they are coming from these players, right? They come from the market makers, or they are linked to their transactions, if you want. They are market makers because they trade in millions or billions, right? They transact in large volumes. Okay, comparing to small traders, they are huge. That's why they are market makers. Okay, our transactions are too small, so tiny comparing to these players, especially in London. Am I right? They have to transact a lot. Okay, and the values are very, very significant. So contribution by international banks in the figures in the BIS. So by the way, that survey by BIS is conducted on, I think, more than 1,000 financial firms, okay, financial institutions, and many of them are international banks. Okay, and they participate in both interbank or the wholesale market and the retail market or the client market. Okay, so what it means is that in London, right, these big players, they trade with one another. Okay, they can have transactions with other international banks. Okay, or big financial companies or big financial institutions. Am I right? They trade in the wholesale market. They also provide the service to individuals and customers. Am I right? We can buy and sell currencies from these players. Correct? So they are there everywhere. They participate in the wholesale market, trading in large volumes, and they also participate in the retail markets, trading in small volumes. And I don't think, I think the most important thing for the retail market, for these players, is that they offer the service. Okay, they offer the service so that they can make some more income. Okay, because those transactions are very small, right? Very, very small comparing to, $100 million, right? Transacting with big players. They are a lot more important for these players. But the good thing about participating in both markets is that they can make guaranteed income. Am I right? Because they can buy at a low price and sell at a high price. Okay, and the other way around, am I right? Depending on what currencies you are talking about. But the idea is that they have the foothold in both markets at the same time, and because of that, they can make what we call arbitrage profits. Am I right? No risk profit. They can obtain funds at a low cost and pass on the funds to individuals at a higher cost. Okay? The difference will be their profit. Okay, will be the bank's profit. And later on, we have the concept of bid-offer spread. Okay, we see that very clearly. Bid-offer spread. Okay, they buy at the bid rate and they sell at the offer rate. The difference being their profit. Okay, so that is the concept of bid-offer spread. I have a definition later on. The banks, international banks, they also make money by doing or performing speculative activities. Okay, so profit-seeking activities, if you want. So the idea is quite simple, right? They have trading house where they have, specialized traders, am I? And they specialize in specific currencies. They participate in the market the same way we do in the assignment, and they make money for the bank, not for themselves, am I? For the bank. And remember what I said last time, right? There's a movie, Team Spirit, and it's an example here if you want. You might want to take a look. And you see that is the exact thing that they do every day, right? They are some smart people. I'm not sure everyone is smart, but they tend to make a lot of money and lose a lot of money as well. And if they lose a lot of money, they end up where you know, right? But if they make a lot of money, they get some bonuses from the bank. Okay, that is the idea. But typically, they are professional traders. Okay? They have access to news and analysis, and on top of that, they have access to a significant amount of funds. Okay, so we have $50,000 in our trading account for the assignment. It is tiny. Okay, these guys, they are allocated something like $10-20 million, right, or even more, right, depending on their position. Okay, and their job is to make money. That's all. Okay. Buy and sell currencies or financial assets to make money. Non-bank dealers, we have a few guys. Investment bank, mutual funds, pension funds, hedge funds. So they are also significant players. Okay, they are institutions, financial institutions. So they can trade in large volumes. They don't have to trade small amounts, okay? Of course they can do that. But the idea is that those financial institutions, they have access to money, to funds, okay? And they can invest in a better way, okay? So the idea is that if you have some money, right? You buy and sell things by yourself, that's okay. If you're lucky, you can make a good income, am I right? But the risk is high because the amount of money you have might be limited, am I right? Might be limited. Mutual funds, for example, right? So they are related to high net worth people, transactions, am I right? So it is a pool of funds by rich people, rich individuals, high net worth people, right? Not, so people. You need to be above a particular threshold to be there, okay? To be in their club, am I right? So, but even they are already rich, okay? They still pool funds together in order to make their life easier, right? With more money, the risk will go down. That is the idea, okay? Mutual funds, hedge funds, the nature is similar, am I right? You can pool funds together in order to reduce the risk and maximize opportunity, of course, am I right? Because nevertheless, they are professional people, correct? They have access to better information, they have better research, they have better analysis, and so on. Clearly, it's better combination of resources. Am I right? Hedge funds, so in many, so the difference is quite obvious, am I right? Mutual funds, you might have access to it, buying small amount, right? Investing a little bit. But hedge funds, you got to be rich, am I right? Because they don't want to make it public, am I right? So they operate in a different way. They don't want too many public participants in the fund. Pension funds also growing, right, and never stop growing, because things like super, right, that will never stop. So the funds keep growing. They have money and they need to invest. Okay, I'm not saying that they will make a lot of money as well. Am I right? Some companies are in trouble at the moment. Am I right? If you read on, if you follow the headlines, right, in Australia, many big players, they are in trouble. Okay, even they have money, still in trouble. They cannot make the money grow. That is a problem. Okay, now the first one, investment bank, right? Lehman Brothers, like I said, or Barings, right? They are good examples for investment banks. So investment banks, they are not like commercial banks. They don't take deposits by customers. They don't do that. Okay, they do different things. They run the services mainly. Okay, they offer the services. For instance, IPO, right? Initial public offerings. They can run that service for listed companies. Okay, that's easy. They can run merger and acquisition services, am I right? Brokerage services. They can also have other related activities, right? For example, if you have a mining project, you want to raise funds, right? You can talk to those people. They have access to industry professionals, okay, to commercial banks, and they know how much you can get from the market, okay? You cannot find out that information by yourself. It's very expensive, okay? It's better to talk to them. Get the funds by talking to these people. Of course, you have to pay the fees, correct? So they might charge you something like 6% industry standard. It depends on which country, but typically that is a cost, am I right? But you save a lot of time and effort, and you might get more money that way, okay? They run the services, but investment banks, many of them expanded in a very significant way, okay? So the nature, by definition, right, those people, these companies, right, they don't get exposure to the market in the sense that they don't want to take the risk themselves, okay? They run the service and they earn the income based on the service. But many of them expanded in a different way, okay? And they offer more than services, okay? They even ended up with private banks, right? Financial assets management is quite obvious. They have research division, okay, some typical thing. But private banking, I think, is risky, okay? Lehman Brothers, for instance, right? If you follow the news and analysis, you will see that they got a lot of exposure to the housing market, okay? And the nature of investment bank is not like that, correct? So you offer the services, but Lehman Brothers, they got a lot of exposure, in particular to the U.S. housing market, okay? To the U.S. housing market. In topic 7, I get back to that, but the idea is that in the U.S., right, at the time, it was like Australia a few years back. It was very easy to borrow money, okay? Very easy to borrow money, and the belief was that it is impossible for house prices to go down, okay? Actually, I had a colleague coming from the US at that, before the crisis, okay? He was telling me, it's too easy. I mean, everyone can borrow money from the bank. They don't have strict, checking and requirements like nowadays. If you want money, too easy. Walk in and you can sign the contract, okay? The banks are happy to do that because the housing market was on the upward trend and it never collapsed in the US, okay? Before, at least in the last few decades, it was like that. So it was safe, but at the end of the day, okay, lenders, commercial banks, okay, they package those lendings in the form of what we call collateralized debt facilities, right? And they sold those assets to the world, okay? So technically, if you buy those assets, you get exposure to the US housing market, okay? Of course, if the market is going up, nothing to worry about, okay? It just counts the money, how much you're making, that's all. But if the market is going down, you're in big trouble, am I? You're in big trouble. And that is one of the reasons for the US crisis, 2007 and 2008, right? Okay, next group of participants in the forex market, customers, right? Individuals is the other way to say it. There are small traders in the market based on the volumes of transactions, right? Individuals, for instance, right, like you and me, when we need money, foreign currencies, to go on a holiday, right, in a foreign country. So travelers, immigrants, students, international students, for example, right, they are participants in the market because they need foreign currency for their life. Business firms, okay, they need to be there as well if they have transactions with the foreign partner, okay, if they export or import something, right, or they run a service in a foreign country, they will be part of the market, okay. And in topic 6, we get back to risk management strategies, right, for these people, for these participants, right. We see how that works in the market. They need to control, to manage the risk because of the fluctuations, am I? Like I said, it might be a risky thing. If you participate in this market and the rate keeps going up and down, it's a headache, right? You don't know what to do, right? It's better to avoid those things, right? So one way for you to get away from that particular risk is to buy and sell currency forward. Okay? For example, if you export something to China, and suppose the transaction is in US dollar, right? Which is typical for many Australian companies, you realize the income in 3 months. Okay? But between now and then, anything can happen, right? Who can guarantee that the Aussie dollar will be 0.7 in 3 months' time? No one can, correct? Anything can happen. It might go up to 0.8 according to many economists, right? Because they say long run it should be 0.8, but it might as well go down to 0.6, right? Especially in this environment, right? Anything can happen. It's too risky. So it's too risky to wait for 3 months, right? So one way is to get away from the risk, buy and sell currency forward, or do something else, okay? And that's something else we'll talk about in topic 6. And those participants, right, they usually buy and sell currencies through the number one players, the market makers, or international banks, right? Because they cannot, me and you, right, I need currency. The only way for me to get those foreign currencies is to go to the bank, okay? Or one of the service providers, right? Because I don't know who is selling. No way for me to know, okay? So that is my only option. Or go to Australian Post. Now they also run the service. But the idea is that I need to buy the currencies from somebody, all right? And that somebody is linked to the market makers, right? So technically I buy the currencies from the market makers. And individuals, customers, firms, they are price takers. Okay? They cannot do anything with the price. Okay? The rates are given by the market makers. No bargaining, no negotiation, right? You see what you see. Buy or sell, it doesn't matter. Okay? You are just one of the small players in the market, correct? One of the many small players. So you buy or sell has nothing to do with the entire market, right? It doesn't affect market in any way. So it's up to you. The numbers are given to you. They are quoted by the banks, and you don't have the bargaining power up there in this market, okay? So basically, it takes the price as given, right? It takes the price, it takes the exchange rates as given. Okay, brokers, they do not take positions themselves, right? So they run the service. They bring buyers and sellers together by charging a fee, correct? So brokerage fees, they will form the income for these people, So the good thing about brokers is that they help protect anonymity. Okay? So for me and you, right? I don't know, for many of you, but anonymity is not a big deal. Okay? I need to go on holiday, right? I go to the bank to buy some Japanese yen, for example. Right? It doesn't matter if they know about me, that's fine, because I'm going there anyway. But some people, they don't want their names to be known by the market. Okay? Especially high net worth individuals, right? They want their names to be protected. So clearly, working through brokers is one way to keep the name in secret. Right? It's one way to protect the names. So you don't need to worry about the other side of the market, right? Who you transact with. So they charge a commission, brokerage fee, and finally, we have central banks. They participate because central banks, they run monetary policy, right? And they have to work on behalf of the government. In order for monetary policies to work, they have to participate in this market. Am I right? On behalf of one country, for instance, right? And not to say all countries nowadays, they have access to the IMF. Am I right? They are part of the IMF voting mechanism. Am I right? They have voting powers within the IMF. Am I right? So funds allocation, for instance, right? They have to be there in order to participate, in order to contribute to the IMF. They receive money from the IMF. They have to contribute, right, money to the IMF as well. So the way it works is that IMF allocates what is called the SDRs, right? So special drawing rights. If you want, if you want, you can say IMF money. Am I right? It's allocated to member countries of the IMF. Okay, and in return, member countries, they have to contribute in their domestic currencies. Australia has to contribute in Australian dollar, right? Japan has to contribute to the IMF in Japanese yen, and so on and so forth. Right? So that is how it works. And the more you contribute, the more power in the IMF you will have. Okay? Of course, there's some mechanism for that to happen. You cannot change the voting power, for instance. Right? It has been within the IMF regulation. The US, for instance, right, can contribute the most of the funds, and the voting power of the US in the IMF is clearly the strongest. Okay, so central banks, they also participate in order to defend their monetary policies. Okay, in particular, if you think about the case of currencies which are fixed to, say, the US dollar, then central banks, we need to be very active in the market. Suppose the Aussie dollar is fixed to the US dollar, okay, which used to happen before, right? Before 1971. So if that is the case, the Reserve Bank of Australia, we need to be in this market in a very active way. Why? Because Australia has only one exchange rate, right? That it announces to the market, it has to defend it no matter what. Okay, that is how it works, correct? If you cannot defend that number, the policy fails and people won't listen to you, right? So if the exchange rate is fixed, the central banks need to be very active in this foreign exchange market in order to defend the number they announces to the market. Okay? Now, if the exchange rate is not fixed, right, like the case of Australian dollar nowadays, still the Reserve Bank, like other central banks, they need to play a role in this market because they don't want the currency, their domestic currency, to fluctuate too much. Okay? To fluctuate too much. RBA, for instance, right, would be in big trouble if the Aussie dollar keep flying up and down. Okay? So fluctuation is not good, correct? Fluctuation is not good. Why not good? Well, if you trade currencies, might be beautiful, correct? You can make a lot of money. But for business firms, right? Uncertainty, correct. Uncertainty. Your friend is suggesting that it is uncertainty that is not good. That's not a good aspect of the fluctuation, right? No one can predict what happens in a few months, am I right? So it is very difficult to run a business in that environment, right? You don't know what to do, okay? You cannot convince the banks to lend you the money, am I right? Because they don't know whether or not you can get back the amount for them, correct? If the rate is stable, right, or if it is forecasted to be stable, then clearly lenders could be very happy to lend you money, okay? If you can make some good return on investment. But if it is fluctuating, okay, they will be very, very reluctant to lend you the money, okay? Because it's very difficult to predict what happens in the future, am I right? So business, even yourself, you don't want to expand the business in that environment, am I right? It's too risky. Anything can happen, am I right? Even though you're selling a good product, you're making a lot of money today, but who knows? Because of the exchange rate fluctuations, in 6 months, that might be a nightmare, okay? Nightmare in the sense that you're not making money. It is also there because even if you want to get rid of it, you can't, okay? Because the debt is huge. There's no way for you to get away from that, am I right? If it is too much fluctuations, am I right? So risk is not what people like, and people tend to avoid it. So if you can smooth out the exchange rate fluctuations, you can convince people that you have a good policy environment. Okay, and in fixed exchange rate regimes, then intervention is very, very frequent because of the nature of the exchange rate setting. Right? You announce to the market what the rate has to be. Right? It is because of the regulation, the policy, the law. So it is your job to defend what you announce. Okay, you have to protect the policy that way. So if the market wants more of the Australian dollar, you have to provide them with more Australian dollars. Okay, if the market wants some more foreign currencies, you have to provide them with foreign currencies. Okay, if you fix the exchange rate, if you don't fix it, you don't have to worry about what the market wants. Okay, because the exchange rate will adjust. Correct? But now if you fix it, you don't have a choice. Monetary policy becomes no use. Okay, we'll see that in topic 4. All right, and finally, before we move on, we take a short break. So, like I said, another angle you might want to look at the market when thinking about the participants, right, is through the nature of the transaction, right? We can have arbitrages, right, in topic 2 and also topic 3. You will see how arbitrages make money in this market. Hedges, so arbitrages, they just simply take, buy and sell the same thing at different prices for immediate profit, okay? Guaranteed profit, no risk. So hedges, they participate in order to avoid, to eliminate completely or at least reduce the size of the risk, okay? They buy and sell currency forward, for instance. So it's one way to avoid the risk. Speculators, obvious, right? So we speculate to make money. Banks, they have trading rooms. They are there to make money. Okay, it's another way to look at the participant of the market. Okay, so let's take a short break before we move on. The next thing we're going to look at for today will be some more concepts and definitions, and then we also have some numbers to look at. So that's going to make things easier to see. Okay, so don't worry. So far, abstract definitions, but in a few minutes you will see a lot of numbers. Okay, and the numbers will would be very helpful in understanding the concepts. So the first thing we're gonna look at when we talk about exchange rate expressions is currency abbreviation or symbols. Okay, so there are certain rules in the market, and typically we have 3 capital letters to denote or to express currencies, right? AUD, for instance, it means Australian dollar. Okay, AUD, Australian dollar. USD, US dollar, and so on. So we have, in most, not always, but typically we have 3 capital letters to denote a currency. The first 2 capital letters, they stand for the country that issues the respective currency. Okay, AUD, then AU means Australia. It means the currency is issued in Australia by the Australian authority. And the last capital letter is, no wonder, it is the first initial of the currency itself, right? Dollar, it means D, am I right? Of course, there are a lot of exceptions in the world. For instance, we have the Swiss franc, right? CHF, also euro, right? It doesn't follow the rule. So a lot of exceptions, and other currencies as well. But typically, you will see the currencies being expressed that way, okay, that it has become a norm. Now, within this unit, we will be very flexible, am I right? So, like I said at the very beginning, the main thing is your understanding, okay? How you express things is not a big deal. Even definitions, there's no way, even for me, I cannot remember all the wording in the definition, am I right? But I can write down the equation, the definition myself in a very comfortable way, am I right? So that is the main thing. So within this unit, you might want to do this, or Australian dollar, you can use the dollar sign, right? With letter A dollar sign, it means Australian dollar, right? So we'll be very flexible with that. Or you can write the whole thing down, Australian dollar. Why not? Okay, it doesn't matter. It's up to you, right? We're not serious about the preference, how we want to go with the currencies. But if you want, so nevertheless, right, in our teaching, right, we have found that it's convenient to stay with the norm. Okay, it's easier to see, to understand things and to explain things. So we're gonna use this system throughout the trimester. Okay, some currency symbols can also be used as well. Now, the first concept of exchange rates being the spot exchange rate. The definition of the spot exchange rate is this one. It is the price of one currency in terms of another currency. And it is also called the bilateral exchange rate. Okay? Bilateral exchange rate. And so the idea is simple, right? You have 2 currencies. And you price one currency in terms of the other. Okay? In terms of the other. So Australian dollar and US dollar, if you have 2 currencies, then you need to define the value of one currency in terms of the other. That is how it works, right? So that is the unique thing about this forex market. It's not like $3 a kilogram of something, right? Here you have currencies. So how many dollars do you need to buy a particular currency? So that kind of idea, okay? So the price of one currency in terms of another currency. So let me give you an example, right? Okay, so as long as you can tell me a number, you are talking about the exchange rate between these 2 currencies. Okay? And it has to be unique, am I right? So you cannot have 2 prices for one currency in the market, okay? So this is only one exchange rate. And the nature of the spot exchange rate is that the delivery of currencies will need to take place immediately, Okay, that's why it is spot market. So immediately means what? If you want to buy currencies, if you go to the bank, you have to give them the Australian dollar, right, in order to get the Japanese yens from the bank. That is one way to have immediate delivery of currencies, correct? But typically, if you transact in a more sophisticated way, for example, if you transfer money from Australia to a different country, right? It is also a spot market transaction because you're not buying currency forward, right? If you go to the bank telling them I want to transfer $2,000, 2,000 Australian dollars from here to Japan, am I right? The bank will be happy to do that because they can earn the commission fee for sure, right? That transaction is also a spot transaction, and the rate will be the spot exchange rate, okay? The bank will use the spot exchange rate to decide that transaction, okay? And in that particular case, the delivery of currencies might take a little bit longer, am I right? Because it's from one country to another. So typically, the norm here is 2 business days, okay? 2 business days. But nowadays, of course, as you know, you don't need to wait that long, right? Sometimes they can do that within the same day for no extra fees, okay? Because of competition. Nowadays, it's very fast. But the norm is still 2 business days, okay? Typically 1 day should work nowadays, 1 business day, okay? But theoretically, you still need to wait for 2 days, and the settlement is through the SWIFT system, okay? The Society for Worldwide Interbank Financial and Telecommunications, okay? They have the SWIFT codes and things like that. So you have to enter the correct code so that the money will be transferred, to the account that you want. This is a very simple example, right? On Monday, Mr. A buys $1 million US from the bank, okay, at a whatever exchange rate. On Wednesday, the delivery of currencies will happen, okay? That is what we mean by 2 business days. You don't have to give the bank the amount straight away, okay? Because this is a lot of money. If it's a few dollars, it's easy, am I right? But $1 million, even the bank is not ready for that, okay? They might want you to wait a bit. So after 2 business days, the delivery of currencies will take place, and Mr. A, we need to pay in euros, am I right? And Mr. A will of course receive that amount of US dollars, $1 million US dollars, okay? So that's how it works. And the exchange rate here is given by this. 1 euro is equal to 1.25 US dollars, okay? So 1 euro equals to 1.25 US dollars. That is the exchange rate in our example. And one way is to say it, right? Everyone will understand, right? 1 euro equals 1.25 US dollars. That's very transparent. But sometimes we don't have the time and space to put that whole thing down, so we need to make it short, okay? So one way, at the end of the day, right, we have, let's say now we have euro, right? Okay, and more formally, we are curious about what? About the exchange rate between the euro and the US dollar, correct? We know the value, the euro has more value in it, right? Because 1 euro can buy you 1.25 US dollars, correct? 1.25 US dollars. So there are many ways to express that, that information. Note that euro 1 is the same as US dollar 1.25, right? That is the exchange rate. How do we express that information in the form of a formal exchange rate. So many people will do like this, yeah, right? Blah, 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 okay? It's one way to say the exchange rate between two currencies, that's fine, okay? Completely fine. In a different trading center, you might see US dollar, euro is something, okay? And you might even see US dollar / euro is something, correct? Or euro / USD is something, okay? Now, at the end of the day, okay, it's just a matter of preference. You can put 1.25 in all of these places as long as you mean what you mean. As long as you say that it means this, that's okay. Am I? If you can tell people buy 1.25, I mean that thing, that's fine. Okay, completely fine. You can even do 1.25 here. You can put 1.25 there or 1.25 there. Okay? Now, what is right? What is wrong? Nothing is right. Sorry, everything is right. Nothing is wrong. Okay? Like I said, it's just a matter of preference. Okay? At the end of the day, of course, you cannot change your mind. Right? What's more important is that once you stick to one of those things, you have to keep moving that way. Okay, that is important for consistency. You cannot express the exchange rate this way for today and a different way tomorrow, correct? People won't understand you. So you have to pick up one of those. Okay, in our trading platform, you will see the first one. Okay, but in our textbook, you will see the third one. Okay, so like I said, nothing is wrong here. It's just a matter of preference. And in this unit, we will stick with this one. Okay? We picked up this one, just a matter of preference again, and it works with the text that we have chosen. Okay? In some other textbook, they use the opposite one. Okay? They will make it euro / USD equals 1.25. That's fine. Okay? Because if you follow their system, they express it in a consistent way, right? And if you follow our system, we will do this in our consistent way as well. Am I? So like I said, it's just a matter of preference, and in the US, people tend to use this one, so we have decided to stay with this system. So from now on, just keep in mind that 1.25 is the price of the euro in this case, right? And it is the price of the currency after the forward slash. Okay? So we have USD / USD. Sorry, euro. So euro is the currency we are talking about. It is the currency we are interested in the value, okay, or the price. So 1.25 is the price of the euro in terms of US dollar. Is that okay? And for study and also examination, right? Please do that because it is our style. If you express the exchange rate the opposite way, it is very difficult to follow in the sense that, well, we understand what you mean, am I? But given the learning has been happening this way, it's better to have a consistent style so everyone can understand what you mean. Is that okay? For the assignment, it's up to you. Okay? Assignment, we are not interested in how you express an exchange rate as long as it is consistent. That's fine. Okay? You can choose one of those methods, right, that I just introduced. Any of this will work. Okay? It's up to you. Totally up to you. But for examination, okay, make sure that you go with our style. Is that okay? Because otherwise, very difficult to understand you. All right. So, I get back to that equation in a minute, but let's move on with the methods of quotation. We have two of them only. So the first one is called the direct quote. Okay, so direct quote, according to the direct quote, the exchange rate is the price of 1 unit of the foreign currency in terms of the domestic currency. Okay, so if we are in Australia and if we talk about a direct quote, right, on a particular currency, it is the value of that currency, right? If we are interested in the value of the Japanese yen, right, then the direct quote would give us the price of the Japanese yen, right, in Australian dollars, of course. Okay, if we are interested in the value of the US dollar, the exchange rate is not going to be 0.7, it is going to be 1.5 something, right, or 1.4 something, right, because the direct quote would tell us the value of that currency, of the foreign currency, of the US dollar in Australian dollars, right? Today, for example, it might be 1.5 something, okay? Or 1.4 something, realistically, not yet 1.5, okay? So that is a concept of direct quote. In the US, likewise, the direct quote on this one would tell us the value of the euro, because the euro is a foreign currency, right? The euro is a foreign currency in the US. The opposite method of quotation is called the indirect quote, and I reckon you understand what it means without looking, right? It's just the opposite. Following the indirect quote, the exchange rate tells us the price of 1 unit of the domestic currency in terms of the foreign currency. Okay? So if we are in Australia, the indirect quote would tell us the value of our currency, right? The Australian dollar, in whatever currencies we are interested in. Okay, so we can talk about the value of Australian dollar in US dollars, 0.7050 for instance, right? So we are talking about the indirect quote from the Australian perspective, correct? Because we are in Australia. So indirect quote would tell us the value of our currency in other currencies, of course. Okay, good. And of course, the same example would tell you that the indirect quote from the US perspective in this example would tell you the exchange rate being 0.8. Why? Because it is the value of the US dollar in terms of euros. Correct? Good. And if you take a close look at this one, I already swap the position of the currencies, right? Because the numbers, like I said, they mean the value of the currency after the forward slash sign. Okay? So after the forward slash sign. So 0.8 means the value of the US dollar in this case, and 1.25 means the value of the euro in that case. And now we have a formal expression of a particular exchange rate. If we have two currencies, X and Y, the exchange rate between the two currencies can be expressed this way. It can be simply X slash Y, or S means spot exchange rate, X slash Y in the brackets. Okay, so let me say that again. So there are two ways, right? You can make it in our example. It could be this one, or it could be S USD slash euro equals 1.25. It's up to you, okay? They mean the same thing. If you don't say S, we understand you're talking about the spot exchange rate, by the way. So it doesn't matter. Okay, but if you're talking about the forward exchange rate at the same time, it's better to use S so that we see the difference between the two. Okay, F means forward exchange rate, S means spot exchange rate. All right? So it depends on what you need in a particular context. Now, given the role played by the US dollar, the currencies are often quoted in terms of US dollar, correct? If you go to the FX platforms, you always see that information, right? So the way the market works is that they provide the quotes in most of the case by showing the values of many currencies, okay, in US dollars. So because of that, the US dollar has a special, from the quote from the direct quote from the US perspective. But the direct quote, again, it is the value of foreign currencies, right, in a particular place. So in this case, in the US, everything is quoted in the US dollar. So if you think about the US, if you stand in the US, then you have a direct quote from the US perspective, correct? And because everything is quoted in US dollars. So that particular situation is called American terms quote. Okay, whenever you quote everything in US dollars, there's a term for that. It's called American terms quote. Okay, just because the US dollar is so powerful, it's so popular. Okay, it doesn't have any other different interpretation. And an indirect quote from the US, right, also has got a name, which is European terms quote. Okay, not a big deal, right? So as long as you understand what that means, that's okay. All right, now this is interesting. The exchange rate, remember in our example, right, 1.25 for USD / euro, 0.8 for euro / USD, correct? And why so? Because the two exchange rates, right, they have what we call a reciprocal relationship. Okay, reciprocal relationship. 1/1.25 would give you what? Exactly 0.8. 0.8, okay? So if the exchange rate x/y is a, if the number is a, then the exchange rate y/x is simply 1/a, okay? 1/a. So in our example here, right, you see the opposite, right? So if you're curious about euro / USD, right? How much is that? It is simply 0.8, right? Why 0.8? Because it's 1/1.25, exactly. So this is how it works. Okay, very simple. Oh, sorry, 0.8. Thank you for that. Is that okay? So just keep in mind that the reciprocal relationship is saying that, and if you want here, I can do the same thing. It is simply 1/the exchange rate USD / euro. Okay? And in value, it is 0.8. Okay? Now, interpretation. This is quite interesting. If the exchange rate goes up, what can we say about the values of the two currencies? Suppose the exchange rate x/y goes up, what do we say? In our example, right, if the exchange rate USD / euro, if this exchange rate goes up, what do we know? We know that, again, at the end of the day, right, that exchange rate means the value of the currency after the forward slash, which is the euro, correct? So if that whole thing, if that exchange rate goes up, it means the value of the euro has gone up, okay? It has gone up. So the other way to say in this case is that the euro has become stronger currency, okay? The currency has become stronger, and technically we say that the euro has appreciated against the US dollar, okay? So we say that the euro versus okay, so the euro has appreciated against the US dollar. Okay. Now, formally, you don't have to be euro and US dollar all the time. If you have two currencies, right, x and y, as long as x/y goes up, if that expression goes up in value, we say that currency y has gone up in value, right? And in our language, we say that we have seen an appreciation of currency Y. Okay, that's it. And how about currency X? When Y is going up against X, it means X has gone down against Y, right? Y is going up, it means X is going down. They mean the same thing, right, at the end of the day. So in this case, we can also say that currency X has depreciated against currency Y, okay? Because Y has appreciated against currency X. It is the same like this one, right? So if we have the opposite to be true, if the exchange rate goes down, we say that currency Y has depreciated against currency X. Okay? And of course currency X has appreciated against currency Y. So at the end of the day, just remember the rule, right? X/Y. That means the value of currency Y. If that thing goes up, currency Y is going up. If that thing goes down, currency Y is going down. That's all. And up means appreciation, down means depreciation. Okay? Good. So let's move on. This dot point, the last one on the screen, is quite obvious, right? Like your friend suggested, because we have only two currencies. If we say that Y is going up, it must be true. Sorry, Y is going up against X. It must be true that X is going down against Y. Nothing else. Okay? So an appreciation of currency Y means a depreciation of currency X, and vice versa. Example. Okay, so here we present we present some flexibilities in using the currency symbols. You see that in this example, we have the exchange rate between these two currencies, right? The pound and the US dollar. So the exchange rate is expressed or quoted this way: $/pound. What does that mean? It means the exchange rate will tell us the value of one pound, right? 1 pound, of course, in US dollars, right? So suppose this exchange rate has changed from 1.9 to 1.45. So it has gone down, right? The exchange rate has gone down over the 5-year period. Would you agree that over this period, that British goods have become cheaper for buyers in the United States? Yes or no? No? Yes? Can I explain why no? Why do you think that it is a no? So it reduce the.
I'm not a specialist.
So suppose the price is the same, right? So all that we see is a change in the exchange rate. Okay. So starting with 1.9. Okay, let's make it simple, right? Suppose a pen, right? The pen, 1.9 pound, 1.9 US dollars. Okay, 1.9 US dollars 5 years ago. Okay, 1.9 US dollars 5 years ago, because it's 1 pound. Suppose the price of the pen is 1 pound, right? So it means 1.9 US dollars 5 years ago. And today, following this example, it is still 1 pound. That's okay, suppose. But in US dollars, it is only 1.45. Okay, this one is easy way to look at the problem. So clearly, this commodity, right, has become cheaper, right? So as long as the value of a particular currency is going down, the goods priced in that currency or produced or export from that country, they become cheaper, okay? They become cheaper. Sorry, say again?
Purchasing power of a consumer increases? We
The
can say like that?
Well, of course, yeah. So that is a smart way to look at the problem. So your friend is suggesting an alternative expression or explanation, right? If you think about the purchasing power of the pound, okay? The purchasing power of the pound, right? So before it was 1.9, Today, it is 1.4, roughly speaking, okay? So the purchasing power has gone down. So that is another way to look at the same thing, okay? Very much the same thing. Good. So this is the explanation, very much repeating what we said. So the exchange rate has gone down. So the dollar has appreciated, the British pound has depreciated, and because of that, goods from the UK have become cheaper, okay? They are cheaper for US customers. All right, next concept, when we are in the spot exchange rate environment, it is called the bid-offer spread concept, okay? Bid-offer spread. So in most of the case, we observe in the market the quotes containing two numbers, okay, a small number and a large number, a little bit larger number. The first number is called the bid rate, and the second one is called the offer rate. That's all, okay, the bid and the offer rates. So the bid rate is smaller, the offer rate is higher, right? And why so? It is like you buy and sell, am I right? So the bank is buying and sell this particular currency. Right? In this case, again, the currency after the forward slash is the US dollar. Right? So we are very much talking about the value, the market for the US dollar. Right? Here the bank is buying at 1.2025. Okay? Because they quote the two numbers. It means they are happy to buy from you at the price of 1.2025. And they are happy to sell that currency, US dollar to EU, at the price of 1.2075, okay, 2075. They make a small amount of money, correct, in the form of what we call the bid-offer spread, which is the difference between these two numbers, right? So again, formally, the small number, the first number, the bid rate, is the rate at which the bank buys currency Y, US dollar in our example, okay? The bank is buying currency Y at that price, at the bid rate. And of course, buying currency Y and selling currency X, like I said, right? It is the same thing because the bank we need to pay, right? So if we go to the bank, am I right? We go to the bank, and let's say the bank is buying from us the US dollar, okay? The bank is effectively providing us with the Australian dollars, correct? Yes, in this case, Australian dollars. So they are selling Australian dollars to us and buying from us the US dollar. So like I said, buying currency Y and selling currency X, they are the same thing here, okay? It is an exchange of currencies. So it doesn't matter which way you go. But if you buy a currency, it means you sell another currency. Okay? You cannot buy without paying. No, it's not fair, correct? So you need to pay. So buying currency Y and selling currency X, it means the same thing here. And the second number, the offer rate, the larger number, is defined this way. It is the offer rate or the ask rate, the rate at which the bank sells currency Y or buys currency X, same thing again, okay? They sell currency Y to customers at a higher price, right? Currency Y, higher price. That is the offer rate. Because of that, we know that the offer rate is always larger than the bid rate. That is the only way for the banks to make money. And the difference between the two is called the bid-offer spread, okay? That is the bank's profit. And sometimes to save resources, the cost in the market can be just in the last two digit numbers, okay, which is in this case 25 and 75, because the numbers before them, they are the common knowledge, okay. In the market, if you watch the movie I mentioned, they don't have time to quote, 1.2025. They just say 25.75 and deal done. That's it, okay? 1 second. They don't have the time, okay? Because 1.20 is a common knowledge. Everyone knows it is 1.20, okay? Unless some big things are happening, right? Then they need more numbers. But in a normal trading environment, 1.20, they are the common knowledge, okay? So in the market, from time to time, you might see the quotes in the form of the last 2-digit numbers. We call them the points, okay? In some textbooks, they call them the pips, but percentage in points, we're not a fan of that, okay? Again, it's a matter of preference, okay? As long as you see our number, the lucky last, the first digits up there, it means the points, okay? So 5 points. 75 means 75 points. This is 5 points, 25 points, okay? So it's our choice to understand the points. Okay, of course, if you go a little bit more advanced, some textbooks, they make the pips different, okay? They make 1 point to be the same as 10 pips, but it's just the preference, okay? We don't go that way. So as long as you understand the last number, number 5, means 5 points, that should be enough. Sorry. So the bid offer spread again is the difference between the two numbers, right? And in our case, the bank buys the US dollar at the price of 1.2025, okay? The second number is the offer rate. It is the rate at which the bank sells US dollars, right? 1.2075, the bank sells US dollars to customers. Good. And they make 50 points per US dollar as a profit in this case, right? So again, this is the recap of what I mentioned before. Buying X and selling Y versus selling Y and buying X, they are the same thing, correct? And because at the end of the day, it is a forex transaction. You buy one currency and sell another currency at the same time, okay? At the same time. So buying X and selling Y versus selling Y and buying X, they are the same thing. Okay, let's move on with the reciprocal relationship. But now, remember, we have the bid and offer numbers. Okay, a little bit more advanced, but still straightforward, I believe. So the question is, again, let's get back to this. We all know that it is about the market for the US dollar, right? Because we are talking about the values in bid and offer numbers of the US dollar, okay? In this case, the value of the US dollar. We all know that the bank buys at 25 and sells at 75, okay? And when we say that, we imply that we are talking about the market for the US dollars, okay? Now, if the question is becoming the Australian dollar, what do we say? Suppose the question becomes, at what rate does a bank buy and or sell Australian dollar? What do we say? It's opposite, okay? Opposite, yeah, opposite. The idea is, suppose you are interested in buying, right? The bank is buying Australian dollars. What does it mean? Buying Australian dollars means selling US dollars. So we have to use the larger number, correct? If we change our tone to focus on the first currency, Australian dollar, the larger number becomes relevant, okay? We say that 75 is actually the rate at which the bank buys Australian dollar, okay? Australian dollar, because they sell US dollar at that price. Does that make sense? Okay, good. So formally, the bid rate on currency X, right? We are talking about currency X, Australian dollar, is given by the offer rate on currency Y. And again, they have the reciprocal relationship. So we can say that the bid rate on currency X is 1 over the offer rate on currency Y. Very much the same thing, okay? We play with just one number. In our example here, the rate AUD USD 2025 and 1.2075. Am I right? And what do we say? Okay. So what we are saying is that we want to know what? The exchange rate US dollar slash AUD, correct? Yes. So we have agreed that we use the offer rate, am I? To work out that bit rate, okay? So let's say of course at the end of the day we have two numbers, right? Two numbers, bit rate and offer rate. But we know that we are going to use 1.2075 for our new bit rate, correct? It is a rate relevant to the bank buying AUD, correct? Buying AUD. So when you do that, you can just ignore this thing, am I? Look at one number. It's easier, right? We know the reciprocal rule, correct? So it is simply 1/2075. That's it, correct? That is the bit rate. And now we look at the offer rate. We need a different number up there, right? A little bit bigger, correct? The offer rate is higher, so we need to make use of the initial bit rate. Okay? Question? Oh, sorry. So something wrong with my typing, as always. Thank you. Okay, good. All right, and the new offer rate is simply given by what? 1/1.2025. Okay, now it's correct, right? So the offer rate will go down to the bit rate, and the bit rate will go down to the offer rate. Okay, with the reciprocal equations. Good. So formally, you have those summary, right? So in order to find the bit rate on currency X, you just make use of the offer rate on currency Y and invert the equation. That's it. Okay? And in order to find the offer rate on currency X, you make use of the bit rate on currency Y. Okay? And eventually, you don't have to remember that technical details, right? Because when you have the numbers, they become obvious. Am I right? You find the reciprocal values, and you will see obviously which one goes to the bit rate and which one goes to the offer rate, correct? Because the bit rate is always smaller. Yeah. Good. So if you stick with our numbers, then the bit rate on the AUD is given by this one, 0.8282, and the offer rate 0.8316. Okay? So hopefully my calculations are correct. And again, if you want interpretations, then 8282 is where the bank buys the Australian dollars, right? And 8316 is where the bank sells Australian dollars to the market. And if you are happy with that explanations, then the concept of cross exchange rate will be straightforward. Okay, cross exchange rate. It means we have three currencies, and we know two exchange rates. Right? The question is, what would be the last exchange rate? Now, take a look at this example. There are three currencies, right? Japanese yen, US dollar, and Australian dollar. And we know that the exchange rate between the US dollar and the Japanese yen is given by this number, 84. Forget about the bid offer thing, right? It's too messy. Let's say there's only one number, 84. What it means is that one US dollar can buy 84 Japanese yens. Okay? And another exchange rate is known, which is this one. AUD slash USD equals 1.2, meaning one US dollar can buy 1.2 Australian dollars. Okay. The question is, suppose the market is in equilibrium. What must be the exchange rate between the Australian dollar and the Japanese yen? okay, which is not known. Well, of course, nowadays, right, it's not like this. We know everything, right, with the hit of a button, so we know everything. But suppose, you know, 2 out of the 3, all right? Can you work out the last exchange rate? That is the question, right? In some countries, it's like that, okay? In some developing countries in particular, they might not be interested in a particular exchange rate pair, okay? But they have other currencies available. So the only option for you is to do 2 transactions, okay? For instance here, right, in order to work out this exchange rate, we have to go through a sequence. First, we convert Australian dollar into what? US dollar. And then we convert US dollars into Japanese yens, okay? Not common, yeah, but in some developing countries, okay? They only have certain currency pairs to trade, okay? And it's not just the regulation, but the market is how it works, because they don't make profit on certain currency pairs. So you have to trade by yourself.
So suppose I get money from India.
Yeah.
So is it converted to USD first and then to AUD?
Yes, yes. That is how it works, okay? Yeah. But like I said, it's for illustration, okay? Nowadays, you know everything, am I right? With the development of information technology, with the Bitcoin, and now people even talk about the IPO, right? People are talking about the ICO, which is now not in a good state. But anyway, it's not like this in our time. But sometimes, right? In some cases, still you have to work out something by yourself this way. Then it is what you can do. Okay? You can. So the simplest way to understand our answer, right, is that you start with $1 Australian. Okay? Why $1 Australian? So the benefit of starting with one unit of a particular currency is that if you end up with certain amount of other currencies, right, like in this one, forget about the calculation. Suppose you can jump to 70 Japanese yen, right, at the end. What does that mean? If you forget about the middle step, right? Starting from $1 Australian, at the end of the day, you end up with 70 Japanese yens. Meaning? $1 Australian equals to 70 Japanese yens. That is the exchange rate, correct? So, of course, you can start with more than $1 Australian, but there's no benefit. So, in this case, you just need to follow 2 steps, right? In the first step, you convert $1 Australian into what? This amount of US dollars. Okay. Sorry, I don't know how much it is. Little bit small. I can just keep the equation, right? So I know that the amount of US dollars is given by 1 divided by 1.2, because 1.2 is the price of the US dollar, right? And after that, I need to convert this whole amount into Japanese yens, right? So I don't need to know how much I have, okay? But all I know is that the exchange rate has to be 84 Japanese yens per US dollar, am I right? So if I convert $1 US into Japanese yens, I get 84, am I right? If I convert that amount, whatever it is, I simply multiply it with 84, okay? If it is $5 US, I multiply 5 with 84. If it is 3, I multiply 3 with 84. Whatever it is, I keep it, am I? What I know is that all I need to do is to multiply whatever it is with 84. And this is my answer, right? 70 at the end of the day. And so if you understand this, we say that the exchange rate between the Australian dollar and Japanese yen is 70, meaning $1 Australian can buy 70 Japanese yens, right? Using the information given to us, okay? Now, if you don't have those 3 currencies, right, then you might want to make use of this conclusion. As long as you have 3 different currencies, You know two of the exchange rates, right? If you know, suppose you know the right hand side of this equation. You know the exchange rate x/y. You know the exchange rate z/y. If you are curious about the exchange rate x/z, then you can just plug them in my equation here. Okay? It is coming out of the two-step story that we just discussed, right? So exchange rate x/z is simply given by exchange rate x/something divided by exchange rate z/that something as well. Okay? Look at the consistency here. So that is how it works. Okay? And in our calculation, exchange rate Japanese yen / AUD is exchange rate Japanese yen / USD divided by exchange rate AUD / USD. So it is simply 84 divided by 1.2, right? So that's why we have this calculation, this result. Okay, now, I don't know how to go with this one, but we need to go through this one, okay? So the idea is that now, you don't have this simple example, right? You have a more realistic story where you have also the bid and offer numbers, okay? How do you plug them in this equation and produce nice results within a few seconds, okay? Now, what I can tell you that the equation still works. All you need to do is to pick up the correct bid and offer numbers, okay? Or bid and ask rates. That is your job, right? And in order to make it transparent, so let me just quickly go to this one. This is my conclusions. I get back to the story in a minute. But at the end of the day, if you look at the top two lines, sorry, second and third line, the lines with the equations, okay? X and Y thing. Can you see that? So you see the same thing, right? X/z is at the end is x/y again divided by z/y again. Alright? Very much the same equation. But now I have to put in the bid and offer numbers, right? And my rule is very simple. The bid rate x/z is simply the bid rate x/y divided by the offer rate or the ask rate z/y. And the ask rate x/z is given by the ask rate x/y divided by the bid rate z/y. Okay? Bid is bid over ask and ask is ask over bid. So the idea that bid is bid over ask is going to be a small number, right? Because bid over ask is a small one, correct? And the second one, the ask rate is ask divided by bid, is a big number, correct? Okay? So let me get back to this with the numbers. But anyway, so you see the similar equation, right? The consistency up there. Now, suppose this is given, okay? The two exchange rates, like before, they are given to us. And our job is to find the exchange rate between the Australian dollar and the Japanese yen again, right? But now we have the bid and offer values. So what can we do? The logic is the same, am I right? In order to find the bid rate on the Australian dollar, we can try something like selling on Australian dollar, right? And see how much at the end we can get in terms of Japanese yen. That is the bid rate, correct? Because we are selling that one Australian dollar to the bank, right? We are selling it to the bank. So let's say Mr. John is doing that. Okay, so before I move on, are you with me? So the idea, what I'm trying to do first is to find the bid rate on the Australian dollar, okay? And I use the same logic. As long as I sell my one Australian dollar and obtain something like 70, now it might be 68 or 71, who knows, correct? Japanese yen. That 68 or 71 something Japanese yen, that number is my bid rate, okay, correct? Because the logic is the same, right? I'm selling $1 to the bank and I get that amount. So that amount is basically the bit rate, right? 70 is the bit rate. So let's say if I do the same thing here, how much Japanese yens I can obtain from the market? Now say we follow Mr. John to sell $1 to the bank, okay? What is the rate available to Mr. John? So Mr. John, of course, he will need to travel through these steps, right? First of all, he need to buy US dollar, correct? And the second step is where Mr. John, what? Buys Japanese yens, correct? So buying US dollar using Australian dollar, what is the relevant exchange rate? Buying US dollars. So which number would be relevant? 1.2 or 1.3? John is buying US dollar from the bank. Obviously 1.3, right? 1.3. So 1.3 will be relevant because John is buying US dollar from the bank. After that, what happens? He is selling that amount of US dollars to the bank in order to get Japanese yens, right? What is the relevant exchange rate? What is the relevant number between 84 and 85? He is selling US dollars to the bank. The bank is buying at just 84, okay? Because the bank, 84 and 85 will be the price of US dollar, but John is selling to the bank. So the bank is not paying 85. They are going to pay 84. So, you know, when Mr. John sells US dollars to the bank, 84 will be relevant. So let me say that again. In step 1.3 is relevant. That's why I put the ask rate in my equation. And in step 2, 84 is relevant. Okay, 84. That's why I put the bit rate in my second equation. Is that okay? So at the end of the day, now you know why the bit rate is simply bid over ask using the same formula. Okay? Nothing different. So the idea here is that if you ignore 85 and you ignore 1.2, you get back to our story here. Correct? Same equation. Similar answers. Alright? So that is the bit rate on the Aussie dollar. And there's a formula for it. As you can see, the bid rate is a bid over ask using the same formula. So I'm done with the bid rate. How about the offer rate? How do I find the offer rate on the Aussie dollar against the Japanese yen in this case? Well, the nature of the offer rate is what? I am buying the Aussie dollar, right? I'm selling Japanese yens in order to get some Australian dollars, okay? But is that okay? That is the nature, right? So let me do the opposite, right? Because the offer rate that I'm trying to find is one where I sell Japanese yen, buys Australian dollar, right? So let me start with Japanese yen instead of Australian dollar, right? And I do the similar thing. Because if I start with Japanese yen, what I get is what? If I do the exact thing, follow these steps. But I'm selling Japanese yen to the bank to get Australian dollars from the bank, I will end up with another bit rate. But now on the Japanese yen. Okay? Because at the end of the day, look, it doesn't matter. I have two currencies, am I? In the first slide, I sell my Australian dollars to the bank to get Japanese yen. In the next slide, I'm going to do the opposite. I'm going to sell my one Japanese yen to the bank to get some Australian dollars. Now, selling one Australian dollar to the bank will give me the bit rate on the Australian dollar. Okay? Then that means if I sell one Japanese yen to the bank, I get the bit rate on the Japanese yen. Okay? Whatever I sell to the bank, the result would be the bit rate on that currency, correct? And the benefit of doing so is that at the end of the day, right, all I need to do is to convert that bit rate on the Japanese yen into the offer rate on the AUD, because they are the same thing. They have the reciprocal relationship, okay? So here, let me go through this one quickly. So I do the same thing. Mr. John does the same thing. He sells the one Japanese yen to the bank in order to buy US dollar. The relevant exchange rate will be the offer rate on the US dollar, right? Which is how much?
85.
Now it is 85. Okay. After that, step 2, Mr. John sells that amount of US dollars to the bank in order to get some Australian dollars. And which number would be relevant? 1.2, 1.3. Because John now sells US dollars to the bank. The bank is going to buy at 1.2. Okay? So in the first slide, 1.3 and 84 will work for me. In the next slide, 85 and 1.2 will be relevant for me, correct? So at the end of the day, you do the same thing and you plug the correct numbers in, you get a value and it's called the bit rate on the Japanese yen. And 1 over whatever you are seeing on the last dot point, the number, this number, right? 1 over this number is simply the offer rate on the AUD, okay? It is the offer rate on the AUD. Why so? Because of our reciprocal relationship here, right? So I think I already deleted it. So AUD slash Japanese yen is simply 1 over what? Japanese yen slash AUD, correct? And if I want the bit, if I want the ask rate here, ask rate on this one, then I need to put what on the second one? The bit rate, okay? 1 over the bit rate will return me the offer rate, and 1 over the offer rate will return me the bit rate, okay? Good. So doing all of those business, I end up with the offer rate to be 70 something, okay, Japanese yen. So the idea is that I have the bit rate 64 something and I have the offer rate 70 something, okay. I can conclude based on the information given to me, the bid and the offer rate on the AUD versus the Japanese yen can be calculated and presented, am I right? So give me this two exchange rate, I will tell you the last one, okay, even if you put in the bid and offer numbers, right? There's no problem with that. Is that okay? Yes? No? Of course you will need to read it line by line again at home, right? In order to understand it. So in the past, right, we used to use this similar kind of setting as an exam question, okay, as an exam question. And our expectation was that you show also the steps, right? Two-step story in both slides, and also present the final answer. So, are you comfortable with this? No? If you think it's too difficult, I can just remove it from the exam and give you something else. But if you think you are comfortable with this, I might give it as an exam question, okay? No? Yes? Okay, we can talk about it later, okay? But anyway, so this is how we understand this kind of question. All right? Good. We still have a few weeks until we finalize what is in and what is not in the exam. But like I said at the beginning, right, the exam will cover everything. We'll cover everything. But as long as we haven't hit the mark yet, we can still change, okay? So if you think that if the majority thinks that it is too difficult, I'm not going to give this as an exam question, okay? And alternatively, I give you something else, okay? Something else might be easier, might be a lot easier, okay? Or might be similar. But any quick opinion? Yes or no? Too difficult? No? You sure? Okay, so if you don't like this stuff, okay, drop me an email and then I can go from there. If there's no, no views against this being an exam question, then I will go with that. Okay, good. And remember, we still have a few weeks until I set the exam questions. So do that within the next 2 weeks if you can, if you want. Okay, it's the same for other stuff. Right? Something that you think that too hard, too difficult to work on, do let me know and I can just save it. Say it?
This one is a bit confusing.
Okay, a bit confusing, good. So my advice, right, is just to take another look at home, right, line by line and see how we go. Okay, so that is the cross-section rate, and I have a lot of examples here. And also in the practice, in the problem set practice, all right? So from this week onward, it will have problem sets. If you go to the website, to the UNIS website, and go to the resources area, right? You can find the problem sets assigned to different topics. Okay, and from today, it will have problem sets. And the way it works is that I will provide the solutions after 2-3 days. Okay, so I give you some time to play with the problems by yourself, and then I provide the solution. Okay, so let's go through this example quickly. Like I said, right, at the end of the day, all you need to do is to apply the equations that we have discussed. This is a summary, right? In practice, you can have any currency as X, any currency as Y, any currency as Z. As long as you apply the equations, right, plug the numbers in, it should be able to show the correct answer. So the benefit of using this thing is that if you can memorize these equations, then within a few lines, you can get the correct answer, right? The final answer. All you need to do would be to explain the steps, right? Anyway, so if we have an example like this one, then we can plug the numbers in and produce the exchange rate between these two currencies, okay? In a similar way. So the exchange rate, the bit rate is bit over ask. So 93 divided by 0.5055. And the ask rate on the pound in this example is ask divided by bit, right? So basically you have 93.25 divided by 0.5050, okay, ask over bit. So larger number divided by smaller number for the ask rate, and small number divided by the larger number for the bit rate. So easy, okay. All right, last thing for today, the forward exchange rate. So similar to the spot exchange rate, the forward exchange rate is an exchange rate as well, but it is contracted today or at a point in time for the delivery of currencies in the future, okay, for the delivery of currencies in the future. So that is the only difference. So spot exchange rate, you need immediate delivery of currencies, but forward exchange rate, you can deliver the currencies in the future, right? According to the terms and conditions, T&Cs, right? Signed today. That kind of idea. All right. And in the forward market, so typically you can sit down with the bank, right? And design any forward exchange rate. But the norm is that we have maturities of 1 month, 3 months, 6 months, 9 months, and 12 months. Okay. Of course, like I said, you can sit down with the bank and make a forward contract and sign a 1 week forward contract, a 3 week forward contract. It doesn't matter. Okay. The bank is happy to do that because the forward contract, at the end of the day, it is a contract between two parties. Okay. You and the bank. Now, example is this one, right? F, by the way, F means forward, okay? So the exchange rate is quoted in a similar way. All we need to add in our quotation would be the maturity, okay? How many months? And here, to make things transparent, we use the number of months, right? Just to explain things. So 6 means 6 months. So F6 means the forward exchange rate for the 6 months delivery of currencies. Now in our example here, USD/AUD 0.8005. Okay, what it means is that it is the value or the price of the Australian dollar in US dollars, right? For a contract we signed today with the bank, but delivery of currencies will take place in the next 6 months. You sign the contract today, nothing to do here, nothing else to do, okay? You wait for 6 months and then make it happen. You cannot change the exchange rate. After 6 months, the rate, the live or the spot exchange rate might be 0.9, 0.7. It doesn't matter, not relevant to you. Because you have signed the contract for 0.8 something, right? You have to make it happen. That is the exchange rate based on the contract. And we buy and sell for currencies forward because of hedging, right? In topic 6, we do that. And speculation, right? Assignment, for example. Now, that's an equation here, a little bit long, but straightforward. So the equation, the name of this equation is the forward premium or discount equation. Forward premium or discount, okay? So F, the little f, is the forward exchange rate minus the spot exchange rate. So let me say that again. The forward premium or discount, little f, attached to a particular maturity, a number of months, and on a particular currency y, right? Here we just have x/y, so we are always after currency y. So it is given by the difference between the two exchange rates, spot and forward. So precisely, forward exchange rate minus spot exchange rate, whatever you have, divide by the spot exchange rate, okay? The difference divided by the run if you want. So, and then you do the conversion. Okay, so you do the conversion this way. You multiply with 100%. It means you don't do anything, right? 100% means 1. You multiply something with 1, it doesn't change. The value doesn't change, but the benefit is that you can convert it into percentage, correct? 0.4 times 100% means 40%, okay? Now, why do I have 360 divided by the number of days? I do that because I want to annualize the number, okay? Look, n might be 3 months, might be 6 months, might be 1 month, correct? But I want the forward premium or discount for 1 year because that is the norm in the financial market, okay? People quote rates for 1 year, okay? The rate you see in the marketplace is for 1 year. Okay, 4%, 2%. They're all for 1 year. So you need to annualize this thing. Okay? Whatever forward premium or discount you have to make it, standardize it for 1 year. And the way you do is to convert from 1 month into 12 months. From 6 months into 12 months. From 9 months into 12 months. That's it. Okay? How do you convert? Well, the equation is simple. 360 is the number of days in 1 year. Divided by the number of days in the contract. If you have 6 months, for example, right, 180 days, it means you just double the number. Am I? If it is 3 months, you have 90 days. It means you multiply the number with 4. That's it. Okay, same for 1 month with 12. Okay? All right. So that is the equation and just some explanation. N is the number of months in the contract. If you end up with the positive answer, you say that currency Y is selling at the forward premium, okay? Because the forward exchange rate is larger or higher than the spot exchange rate. So currency Y is selling at the premium, okay? And if the number is negative, if this value is negative, we say that the forward exchange rate is less than the spot exchange rate, and currency Y is selling at a forward discount, okay? Forward discount. So forward premium means forward exchange rate is higher, and forward discount means the forward exchange rate is lower than the spot exchange rate. That's all, okay? And if you have the answer to be 0, it means the forward exchange rate and the spot exchange rate, they are exactly the same, right? And you say that currency Y as well as currency X, they are selling at par. Okay, it means forward and spot exchange rate, no difference between the two. Now, if currency Y is selling at a premium, we know that currency X must be selling at a discount because the exchange rate, right, on currency X has a reciprocal relationship with the exchange rate on currency Y. Okay, so if Y is selling at a premium, X must be selling at a discount, and the other way around. Okay, it's just a matter of conclude about the direction of the currencies, that's all. Okay, no technical thing here. All right, and this is an application, right? If you put the numbers in my example here, you end up with a value, in this case, 0.19%. What does that mean? It means it is, first of all, it is positive, right? It means currency Y, which is, in this case, the Japanese yen, is selling at a forward premium. Okay, and of course, the US dollar is selling at a discount, forward discount. Okay, and this is the size of the forward premium. Okay, good. All right. And this example, so let me skip this one because I just want to show you what's happening here. So the business here is that a guy is having a business, a cameras business, okay, importing cameras, selling them for a profit, okay. So the example is asking you what would happen if the guy does not lock in the exchange rate using the forward contract, okay. If he waits until the camera arrives, right, after 1 month, in order to make the payment, what would happen? Because waiting means taking risk. You know, anything can happen. The rate can go up, the rate can go down. But if he locks in the price at the forward exchange rate, he doesn't have to worry about waiting. Okay? So in the answer, we explain that by using a forward contract. In this example, you should take a look by yourself at home. The guy can remove uncertainty completely. Okay, he doesn't have to worry about exchange rate fluctuations. Right? So that is one benefit of using, a forward exchange rate for hedging. Okay. All right, and this is the last slide. So we have two methods to quote the forward exchange rate. The outright method is similar to the spot exchange rate. Right? You quote the exchange rate using two numbers, bid offer numbers, right? The bid rate and offer rate. Same way. The second method is called the swap rate method. This one is more interesting. Okay, you quote the forward exchange rate not by the whole numbers like this, but by the small points. Okay, the small points. So the idea is simple. Everyone knows the spot exchange rate at the moment, am I right? So when we talk about the forward exchange rate, we compare those numbers with the spot exchange rates, am I right? And we quote the difference. Okay, so people quote the difference. They use two small numbers, A and B. A for the bid rate, B for the offer rate. Okay, and they are the difference between the forward exchange rate and the spot exchange rate. Okay, so the idea is this one. Okay, take a look at my table here. right? The spot exchange rate 1.2025, 1.2045, am I right? If you are curious about 1 month forward exchange rate, right? People would tell you it is 1.2035, little bit higher, 1.2065, little bit higher, okay? So if they do that, they are after the first method, right? Outright method, nothing new, correct? But another shortcut method is to use 10 and 20. That's it. They quote you 10 and 20. The forward exchange rate at the moment is 10 and 20. Okay? It means you need to add 10 points to the spot rate to get the bid rate, and you need to add 20 points to the spot offer rate to get the offer rate for the forward exchange rate. Okay? You just need to add the points in. Now, 10, 20, 10 is smaller than 20, right? So you add the points. Sometimes they quote 50, 40. The first number is larger. In that case, you need to take away those points from the spot rate. Okay? You need to take away those points. You need to take away 50 points from 1.2025 in order to get the forward exchange rate for the 6 months in this case. And likewise, you need to take away 40 points from the spot rate to get the offer rate for the 6 months forward exchange rate. Okay? So depending on whether A is larger or smaller than B. Okay? If A is smaller, you just add those points to the spot rate. If A is larger, you take away those points from the spot rate in order to get the forward exchange rate. Okay? So, and the cross exchange rate for forward maturities, you don't have to worry about them because we don't see the benefit of discussing them in this unit. Alright, so that's all for today, and thanks for coming, and I see you again next time.